The chip war has entered a new phase. Not louder, not flashier, but far more dangerous. On the surface, the United States still appears ahead. Advanced chips, dominant firms, global standards. But beneath that surface, China is closing the gap aggressively. And once that gap is bridged, the structure of the entire technology ecosystem changes. This is not about winning a benchmark race. It is about scale, cost, and control. Right now, China lags behind in the most advanced AI chips. That much is clear. But the moment Chinese firms reach functional parity, the advantage shifts rapidly. China does not need the best chip in the world. It needs a good enough chip produced at massive scale, at dramatically lower cost. Once that happens, margins across the global semiconductor industry collapse. Companies like Intel, AMD, and NVIDIA are not threatened by innovation alone. They are threatened by commoditization. When China scales production, prices fall. When prices fall, revenues compress. And when revenues compress, valuations follow. This is not hypothetical. It is exactly what happened in solar panels, consumer electronics, and electric vehicles. But hardware is only half the story. The real force behind China's strategy is human capital. Nearly half of the world's AI researchers are Chinese. Around 70% of recent AI patents originate from China. The ecosystem is dense, competitive, and brutally efficient. Developers are not just building models. They are deploying them at scale, inside real industries under real constraints. This matters because AI dominance is not determined by who trains the biggest model. It is determined by who applies AI most effectively. China understands this. That is why its strategy does not revolve around chasing artificial general intelligence fantasies. It revolves around inference, practical AI, fast, reliable, low latency systems that work in healthcare, logistics, surveillance, manufacturing, and defense. Inference is where value is realized, and inference is where China already excels. While US firms pour billions into training ever larger models, China optimized deployment. They focused on efficiency, predictability, and cost. They built systems that answer questions instantly, process images reliably, and operate under power constraints. These systems are not glamorous. They are powerful. And this is where the US strategy begins to show cracks. American tech giants have become obsessed with building the ultimate AI. AGI, superintelligence, whatever label you prefer, that pursuit is expensive. It burns capital at an astonishing rate. NVIDIA's recent move into inference technology, spending tens of billions to acquire critical capabilities, is not a show of strength. It is an admission that the market has shifted. Inference chips require different priorities: low latency, power efficiency, predictable timing, scalability. There's no point in having the most powerful chip if companies cannot afford it or deploy it broadly. China understood this years ago because it had to. It could not afford the training arms race, so it took the practical route. Now the US is trying to pivot. But pivots are hard when structural weaknesses exist. The first weakness is manufacturing. China's ability to iterate and optimize inference chips comes from its industrial ecosystem. It has the factories, the suppliers, the labor force, the logistics. Manufacturing is not an afterthought. It is the backbone. In contrast, the US industrial base has been shrinking for decades. Tariffs raised input costs. Immigration restrictions slowed workforce growth. Manufacturing investment declined. Yes, data centers are being built, but data centers alone do not create industrial resilience. You need factories that can iterate hardware quickly. You need scale. You need feedback loops between production and design. China has that. The US does not. And as manufacturing shrinks, the problem compounds. Fewer factories mean fewer jobs. Fewer jobs mean political pressure. Political pressure leads to automation. Automation reduces employment further. This is not a solution. It is a spiral. The second weakness is power. AI does not run on ideas. It runs on electricity, massive amounts of it. China generates roughly twice as much power as the United States, and its build-out is accelerating. Fossil fuels, solar, nuclear, everything. Since 2020, China's energy expansion curve has steepened dramatically. The US, meanwhile, struggles to keep up. Power generation growth lags demand. Grid expansion is slow, permitting is complex. This creates a hard ceiling. You can have the best AI chips in the world. If you cannot power them cheaply and reliably, they underperform. Inference at scale requires abundant energy. China has it. The US does not. This is where the chip war intersects with something deeper: commodities. Because advanced chips, data centers, electric vehicles, and military systems all depend on materials. And one material sits at the center of all of this: silver. Silver is essential for electronics. It is essential for energy systems. And China is tightening control over it. As silver prices surge, physical metal is flowing toward China. To see where this is really going, you have to stop thinking about chips as isolated products and start seeing them as nodes inside a much larger system. Chips do not exist on their own. They depend on factories, energy, materials, logistics, and policy. When one of those pillars weakens, the entire structure becomes fragile. This is where the U.S. problem deepens. The American strategy assumes that technological superiority alone is enough. Build the most advanced chips, train the most powerful models, win through innovation. That approach worked in a world where the U.S. also dominated manufacturing, energy, and supply chains. That world no longer exists. China does not need to beat the U.S. at the top end. It needs to flood the middle. Once Chinese firms close the gap on inference performance, scale takes over. China can manufacture at volumes the U.S. cannot match. That scale drives costs down relentlessly. Lower costs expand adoption. Wider adoption generates data. More data improves models. Better models reinforce adoption. This is a self-reinforcing loop. The U.S. approach is the opposite. Advanced chips are expensive. Training massive models consumes enormous power. Costs rise. Access narrows. Only the largest firms can participate. Innovation becomes concentrated rather than distributed. That slows real-world deployment. This is why China's AI ecosystem feels more alive. It is not centralized around a handful of hyperscalers. It is spread across startups, universities, provincial governments, and industrial firms. Competition is intense. Failure is tolerated. Subsidies are weaponized. Beijing is deliberately recreating what it did with electric vehicles. Flood the market with capital. Force firms to compete brutally. Let the strongest survive, then dominate globally. The funding mechanisms reflect this intent. China recently launched multiple national venture funds focused on technology. One of them alone exceeds 100 billion yuan. The capital comes from ultra-long bonds. Borrowing costs are minimal. The timeline is measured in decades, not quarters. This matters because the U.S. system is optimized for short-term returns. China's system is optimized for endurance. A 20-year horizon changes behavior. It allows for losses. It allows for redundancy. It allows for massive overinvestment in capacity. Western investors would call this inefficient. Strategists call it decisive. Meanwhile, U.S. chip makers are beginning to realize where the real battlefield lies: inference, deployment, cost. That realization is why NVIDIA made its aggressive move into inference technology. Spending tens of billions to secure that capability is not a growth story. It is a defensive maneuver. And defense is always more expensive than offense. But even with the right chips, the U.S. faces structural limits. Manufacturing capacity continues to erode. Tariffs increase the cost of inputs like steel and aluminum. Workforce growth is weak. Skilled labor is scarce. Immigration policy reduced flexibility. The result is fewer factories, slower iteration, and higher costs. This becomes a feedback loop. Less manufacturing leads to less learning by doing. Less learning reduces competitiveness. Reduced competitiveness justifies more automation. Automation reduces employment. Political pressure rises. Policy uncertainty increases. Investment hesitates. China experiences the opposite loop. More factories create more learning. Learning improves efficiency. Efficiency lowers costs. Lower costs expand output. Output reinforces scale. Scale attracts talent. Talent drives innovation. This is not ideology. It is mechanics. Then there is energy. AI inference at scale is energy intensive. Data centers consume massive power. Chips require stable, cheap electricity. China has built energy like a strategic weapon. Coal, solar, hydro, nuclear. Everything is on the table. Redundancy is intentional. The U.S. energy system is constrained. Grid expansion is slow. Power generation growth lags demand. Even as NVIDIA chips pile up, there is not enough electricity to run them optimally. This is not a theoretical problem. It is already visible. Cheap power is not optional. It is decisive. And this is where commodities enter the picture again. Silver sits at the heart of electronics, power systems, and industrial processes. China is restricting exports. Physical silver prices inside China are trading at massive premiums. Metal is being pulled from London and New York into Chinese vaults. Arbitrage is draining Western supply. This is strategic accumulation. China is doing what it always does: secure supply first, then regulate access. Once licenses are required, leverage is established. Western industries pay more, costs rise, margins compress, debt increases. This is not about punishing the West. It is about reshaping incentives. Higher input costs force U.S. firms to borrow more. More borrowing weakens balance sheets. Weaker balance sheets reduce flexibility. Reduced flexibility limits strategic options. At the same time, China acquires silver at far lower production costs. Asian silver production remains below $10 an ounce. North American production is closer to $20. Supply chain efficiency widens the gap further. This is how supply chains become weapons without firing a shot. The chip war is no longer just about semiconductors. It is about who controls the foundations of industrial power: chips, energy, materials, manufacturing. The U.S. can still compete, but competition now requires rebuilding entire systems, not just writing checks. And rebuilding systems takes time, money, and political alignment. China has prepared for this moment for decades. The question, at this point, the chip war stops looking like a technology race and starts looking like a resource war, not in the traditional sense of tanks and territory, but in terms of who controls the inputs that make advanced economies function. This is where the situation becomes dangerous for the United States, not because of a single weakness, but because of how those weaknesses compound. Let's connect the dots. Advanced chips require massive amounts of power. Power requires infrastructure. Infrastructure requires materials. Materials require stable supply chains. Break one link, and the entire chain slows. China is targeting the chain itself, not just the end point. Silver is the clearest example. Silver is not a niche metal. It is essential for chips, data centers, electric vehicles, defense systems, and energy transmission. As China tightens export controls and stockpiles supply, it forces the rest of the world into a bidding war. Prices rise, availability shrinks, planning becomes harder, costs become unpredictable. This matters because AI inference is not a lab experiment. It is an industrial process. Hospitals, factories, logistics networks, and surveillance systems require stable deployment. You cannot roll out AI at scale if key inputs fluctuate wildly or depend on foreign approval. China understands this asymmetry. By restricting silver exports through licensing rather than bans, Beijing creates uncertainty without provoking immediate retaliation. Every Western firm now has to ask a silent question. Will we get approved next quarter? Will prices spike again? Should we stockpile? Should we delay projects? That uncertainty alone slows momentum. Meanwhile, China's domestic industries face no such friction. They get priority access, they get stable pricing, they get predictability. That predictability is an enormous competitive advantage. Now layer energy on top of this. China's power generation capacity is not just larger than the United States, it is more flexible. Beijing does not care whether energy is green, brown, or politically fashionable. It cares whether it works. Coal plants are built, nuclear reactors are approved, solar farms expand at scale, grid redundancy is treated as national security. The United States does not operate under the same logic. Environmental regulation, local opposition, and fragmented governance slow projects. Even when money is available, time is not. And time is the most valuable resource in a technological arms race. This creates a paradox. The US is spending more on advanced chips than ever before, yet its ability to deploy those chips at scale is constrained by power availability. China, with slightly less advanced hardware, can often deploy more effectively because it has the energy to support it. This is why inference matters so much. Inference chips are about efficiency, lower power consumption, predictable performance, reliability. China built its AI ecosystem around these constraints because it had to. The US is now trying to pivot into this space, but pivots are costly and slow when incentives were misaligned for years. And here is where the financial pressure builds. Higher energy costs, higher material costs, higher manufacturing costs. All of this feeds into higher debt. The US system relies on borrowing to bridge gaps. Borrowing works when growth outpaces interest. It fails when costs rise faster than productivity. China is deliberately pushing on this pressure point. By raising the cost of key inputs like silver, China forces Western firms to either absorb losses or pass costs on. Passing costs on reduces competitiveness. Absorbing losses weakens balance sheets. Both outcomes reduce strategic flexibility. This is not accidental. Supply chain weaponization does not require cutting someone off completely. It requires making access expensive, uncertain, and politically conditional. That is enough to tilt outcomes over time. And time favors China. China is not optimizing for quarterly earnings. It is optimizing for positioning in 2030 and beyond. Subsidies are not viewed as waste. They are viewed as investments in dominance. Overcapacity is not a flaw, it is a tool. The United States, by contrast, is trying to solve a long-term structural problem with short-term financial tools. Subsidies are debated, infrastructure is delayed, industrial policy is fragmented, political cycles disrupt continuity. This asymmetry is the real battlefield, and it explains why the chip war cannot be won by sanctions alone. Blocking access to advanced US chips slowed China temporarily, but it also forced adaptation. China shifted focus, it doubled down on inference, it invested in domestic tooling, it secured materials, it expanded energy. Every restriction created incentives to build alternatives. Now those alternatives are maturing. This does not mean the US loses tomorrow. It means the margin for error is shrinking. Each delay compounds, each cost increase matters more, each supply shock hits harder. The most dangerous moment in any rivalry is when one side realizes it must rebuild entire systems under pressure. That is where the US is now. And the final question becomes unavoidable. If commodities, energy, and manufacturing are becoming the real sources of leverage, what happens to a system built primarily on finance, services, and debt? That answer defines the next phase of this conflict. And that is where this story ends. What we are witnessing is not a tech race in the traditional sense. It is a systems confrontation. Chips are just the visible layer. Underneath lies a much deeper struggle over energy, materials, manufacturing capacity, and time. And time is the variable most people underestimate. China is not trying to win fast. It is trying to win last. This is why the comparison with past tech cycles fails. In previous eras, leadership was determined by who innovated first. Today, leadership is determined by who can sustain pressure the longest. That is a very different game, one that favors scale, redundancy, and control over inputs rather than elegance or breakthroughs. Look at what China has assembled: a massive industrial base that can iterate hardware rapidly, an energy system expanding faster than any other major economy, a workforce deeply integrated into engineering and applied science, and now tightening control over strategic materials like silver. Each piece reinforces the others. Silver is not an isolated lever, it is a multiplier. Restrict silver, and electronics become more expensive. Power infrastructure becomes more expensive. Defense systems become more expensive. AI hardware becomes more expensive. Costs ripple outward, and every ripple increases the burden on Western balance sheets. This is where the U.S. vulnerability becomes acute. The American response to strategic pressure has historically been spending. Borrow, subsidize, stimulate, and out-innovate. That approach worked when debt levels were manageable and supply chains were globalized. Today, debt is already high and supply chains are fragmenting. That means every dollar spent buys less resilience than before. As silver prices rise and access tightens, U.S. industries will face a choice: pay higher costs or delay projects. Neither option is benign. Higher costs push firms toward more borrowing. Delays slow deployment and competitiveness. Both outcomes weaken strategic positioning, and this pressure does not remain confined to technology. It spreads into defense, energy, transportation, and infrastructure. AI does not exist in isolation. It is embedded everywhere. Any constraint applied upstream cascades downstream. China understands this cascade. That is why its strategy is quiet. No dramatic announcements, no overt bans, just regulation, licensing, and accumulation. By the time markets fully process the shift, the leverage is already locked in. This is the same pattern seen with rare earths. Secure supply, dominate refining, introduce controls. Let others scramble. Years later, alternatives remain incomplete. Silver follows that script almost perfectly. Now add geopolitics. The global economy is splitting, not completely, but decisively. Western systems on one side, China and the BRICS bloc on the other. Trade flows reorient, payment systems fragment, commodity corridors realign. This is not speculation. It is already happening. Silver deposits reinforce this divide. Russia and China together control hundreds of millions of ounces of undeveloped silver. Latin America holds massive reserves, and China is deeply embedded there through infrastructure, ports, and investment. Peru, Chile, Mexico. These are not random engagements, they are strategic. The Belt and Road Initiative was never just about trade, it was about access. Ports, railways, energy grids, and resource corridors. Copper, lithium, soy, oil, and silver. The returns on that strategy are now becoming visible. The U.S. can respond. But response requires rebuilding. Rebuilding factories, rebuilding energy capacity, rebuilding supply chains, rebuilding trust. That takes time. And time is the one thing China has already banked. This is why inflation becomes the default outcome. When constrained supply meets strategic spending, prices rise, governments print, debt expands, currencies weaken, hard assets reprice. This is not ideology, it is arithmetic. Silver rising is not the cause, it is the symptom. Even if silver corrects, the underlying pressure does not disappear. The race for control over materials, energy, and manufacturing continues. The spending continues. The fragmentation deepens. This is why this moment matters. Not because silver crossed a number, not because chips are getting faster, but because the structure of power is shifting from abstraction back to physical reality. Control the inputs, and you influence the outputs. Control access,